Good evening, trader friends, yos, trading people that I like to talk to. How's everybody tonight? Hello to FX Street. Welcome back to session number 5 of the MACD trading webinar series. I've enjoyed some nice email comments back from people and whoever's here live tonight. Thank you for being here live, and I just want to invite you to drop your questions in the comments chat section, and I will check for your questions at the end. I'm easily distracted, so I usually try to get through my presentation first, and then I'll go to the questions at the end. So good to be here with you. Good to be starting another week. Happy Monday or Tuesday night, whatever it is for you. And if you're joining us in the recordings, welcome to you as well. Let's jump into session number 5 and see what we can learn today. Oops, I got to share my screen. Almost forgot. Share. That's just kind of crazy looking. Okay, slideshow. Here we go. All right. Let's see. Okay, hopefully you're with me. For some reason, it doesn't allow me to use my laser pointer, so I have to get used to that. All right, this is the agenda for tonight's session. It should be pretty short again tonight, maybe 30 minutes. And then our next session is going to be a little bit longer to get you ready for that. But tonight we're going to talk about stop losses and profit targets. We're going to talk about how current market conditions can be assessed mathematically to help you out with the decision of where to place that stop loss and where to put your profit target, or where to take profit. I like them to match the current market conditions, and of course I have a button for that. The button is on sale finally. My website was kind of mangled in the last few days, moving from one server to another with the hosting company, but I have it pretty much almost all back to normal. But certainly you can get into the button program if you're interested. Here is the website that you can visit. It's simplycombo.com/button-fall-sale. I'll show you that link a few more times, and we're going to put it in the chat for you as well today. And you can always email me, combotraders@gmail.com, if you didn't quite capture that link and you want more information. All right, so on with tonight's lesson. When it comes to taking profit, we want what comes easy. What takes easy. I take what comes easy. And when it comes to that stop loss, you know, there are woes when you get it too tight or you have it bigger than it needed to be, and we've all experienced that. So we're going to talk about that tonight. But you know, I like to start with a review. It's important to me that if you spend this time with me going through the MACD trading series, that you take something away that you will remember, that will help you with your trading, that will just take, you know, a few bits away from this idea that I have about how the MACD can help you, and I feel like I've done a good job for you. So, I'm going to do a review just to make sure we're making it stick in your brain. Number one, the MACD's job is to watch for change in the current market conditions. All right, don't forget, that's the MACD's job. So when you see the MACD on your screen from now on, you're going to already be thinking, okay, the MACD is there to show me when there's something going on. It shows me when there's a change in the current market condition. And number two, remember, the MACD line crosses 0, and that's a hopper. It's a point in time where it might be a good point of entry for opening a new trade. It tells us something about direction and momentum, because when the MACD crosses 0, something new is happening. Number three, for the counter trend, which is that move against the current market direction, it's called a reverse trigger finger when the MACD line crosses the signal line coming back to 0, coming back home. That is called a reverse trigger finger, and it's the counter trend signal from the MACD that tells us that it could be some good timing for that counter trend trade entry, which is the most reliable trade pattern in the market, but the most difficult maybe sometimes to get with timing, to get the timing right. And number four, the purpose of the signal line is to have something to compare the MACD line to. So if the MACD line gaps away from the signal line, something is happening and momentum is there. Now that's just a quick review on some of the stuff we've talked about thus far. You can always review the recordings at FX Street of the previous lessons, and I would hope that you would be willing to do that. So this is just also part of the review. When the MACD line crosses the zero line, it's a hopper. It's a good time, maybe a good time to enter a new trade. It tells us something about direction, because if the MACD is anywhere above zero, market direction is up. It tells us something about momentum, because if there's a change in the current market direction, momentum is likely to show up. And so pinpointing the hopper gives you a lot of information. It could be an exit to a trade that was in the opposite direction. It could be an entry to a new trade going in the current direction, but it's a hopper when the MACD line crosses zero. When the MACD line up here, where my pointer is, crosses the signal line. Now you notice MACD is far away from home. It's far away from that zero level. That is the counter trend signal that we might have some good timing for momentum, for getting a piece of the action when the market goes into some sort of a retracement pattern or a reversal. All right, so that's the quick review. Tonight we're going to get into our new lesson, which is about stop losses and profit targets. Are you ready? Let's start with taking profit. My favorite subject, right? Your favorite thing to do, my favorite thing to do. But whoever had trouble figuring out how much profit to take? And, you know, I might start with the question of, well, how much profit do you want? And you might think that's a funny question. You might think, well, I want as much as I can get, and I want to tell you that's a bad answer. That's not going to work with me, and it doesn't work with you either. You need to think about how much profit you want, and do a little bit of spend a little bit of time putting some thought into that question, so that you can be really clear about that. And it makes me think of the situation where if you've ever taken 20 pips of profit, maybe, you know, your trade started slow, and by the time it got moving, you got up to 20 pips of profit, and you just kind of felt like uncomfortable with it or whatever. And so you close that trade with profit, 20 pips. And then you felt bad because you saw the market go 120 pips in your favor. So you felt like you did something wrong because you only took 20 pips. And then there's the flip side of that coin is, have you ever had a trade, you know, that at one point in time it was up 70 pips or 170 pips. It was really profitable. But before you could close it, the market turned around, and by the time you close that trade, it turned into a loss. These are really common experiences that traders feel, and I don't like either one of them. I don't want to feel bad when I only take 20 pips and the market keeps going, and I feel like I did something wrong. And I also know how frustrating it can be and how slippery those pips are when you have 20 pips in the bag and it slips out before you have a chance to close that trade. Well, I'm going to tell you something that no one else will tell you, I'm pretty sure, and here it is. You should never, ever feel bad about taking profit, period. Ever. Don't ever feel bad again about taking profit. All right, so if you took 20 pips of profit and the market kept on going, it could have just as easily turned around on you. So all the people that make you feel like they took so much more than you did and you should have stuck in there, just keep in mind that there are other times when they tried to hold for more and they ended up losing more. So the point of this industry, of our jobs as traders, as of this game, I hate to call it a game, but you know, metaphorically, is that we want to take a profit. So don't ever feel bad about taking a profit, period. Okay, hope we put that to rest forever. Now, you know how they say that you need to cut your losers short and let your winners run. Have you ever heard that before? It's really common mainstream advice that you get from trading books and your favorite gurus maybe, and people that talk about trading. You know, maybe you hear stories from some of the professionals, and you know, they got fired because they didn't let their winners run, and they cut them off too soon, and all that kind of stuff. Well, whoever they are, I don't really know who they are anyway, but you've heard this before too, right? So where did you hear it? You maybe can't remember either, but this is a pretty familiar thing. Cut your losers short and let your winners run. Let your winners run. Well, as good as that sounds, you know, even though we would like to agree, the problem is, who knows which trade is going to be the loser and which trade is going to be the winner? We don't know. Okay, so it's a stupid thing to say. So if anyone ever tries to make you feel stupid for not letting your winner run, you need to realize that it's a stupid thing to say, because nobody knows which trade's going to be the winner and which trade's going to be the loser. So it's the kind of thing that people say to sort of, put themselves in this position of authority, and it's really a very stupid sentence. And so now you know, and you'll never fall into that trap again. And here's what I want you to remember. The number one way to make money trading is to close your trade when it's profitable. When you get some money in the bag, close the bag. That's the end of my trading story. All right, when you get some money in the bag, close the bag. When I make 30 pips, I am successful. When the market ended up going 130 pips and I only made 30, I'm happy. It means it wasn't a close call. I probably got those pips with momentum. Boom, done. In, out, got my goal, mission accomplished, I'm out the door, right? So that's kind of what I want to suggest that you should feel when you take profit and the market keeps on going without you. It is not our job to get into the uptrend at the very bottom and get out at the very top. That's not our job. Our job is to track some repeatable patterns in the market and get in and take what comes easy and get out and do it again tomorrow. Now on the flip side, if I have the situation where the market ends up only barely giving me my profit, like it went 31 pips and I got out with 30, I'm okay. I'm happy, I'm happy that I didn't lose, but I'm also mostly just relieved. Like that was probably not my best trade setup. I don't like it to be a close call like that. And so people that really like to brag about how they got out of the trend right at the top or something like that, that is luck, in my opinion. Maybe they were lucky that time. Maybe they were lucky other times. They're not talking about all the times that they held on and then it turned around and ended up into a loss because they waited too long. They're not talking about those examples. So what I want to talk about is taking profit, right? So if I set out to make 30 pips, I don't even care if it went 300 pips. I don't care. I know that I got what I set out to accomplish, and that makes me feel very successful. All right, so I want what comes easy. That's what I'm getting at here. And 30 pips is an amount that comes pretty easily in everyday price action in Forex. So I've been told by some of my clients or some people on Twitter that 30 pips is not enough. It's just laughable. It's just not a large enough amount. And it's really funny because I come back with the question, well, how much do you want to make? The funny thing is, to me it's funny, is that most people don't have an answer. They tell me 30 pips is not enough, and yet they can't tell me exactly what is enough for them. So how can you possibly be successful when the truth is you don't even know what you want? Can you see how that can kind of end up in a dead end for you? So figure out what you want so that you know when you get there. So when you get there, you know it. Know what you want, so if you fail to get there, you can figure out why and you can fix it. That's really what it's all about. Know what you want at the end of a year and figure out just how easy it is to accomplish that goal with 30 pips a trade. You might be surprised. Now, I could go on for hours on this subject, but I'm going to leave it alone with this thought. If you made 30 pips just 2 times a week, every week for the last year, how would that look right now in comparison to what you were trying to accomplish? Right? My guess is that 60 pips a week creates the fortune, and aiming for higher results, aiming for something higher results in a loss, creates the loss. So it's just an idea. It's just a thought that I want to throw out to you. And here's the thought. It takes so much less than most people think. So stop thinking that you have to take 30 trades a week in order to pay off all the problems and have this, fear, this idea that you're not doing enough. You're doing enough. It doesn't take that much. It takes less, not more. And with the MACD strategies alone, 2 trades a week for 30 pips should be pretty easy to accomplish. All right, so this is my solid money management advice. When you have some money in the bag, close the bag. And don't look back. Don't look back and say, oh, now I feel bad because the market kept going. You close the bag on profit, you win. That trade is over. You are out the door. And then tomorrow you come back and you do it again. That's really how you keep a clear head in the game of trading and in the world of trading. I don't know why I keep calling it a game. That's kind of funny. All right, so profit targets for capturing the right amount every time. That's what I want to talk about in this lesson. Because some markets cover more prices in a single day than others, right? So something like the pound Aussie and the euro yen can go 150 pips in a single 4-hour bar. It's not unusual at all. While other pairs such as euro US dollar, euro pound, dollar yen, they might only do half that in the same amount of time. So the question is, what's the right amount for your profit target? So I said 30 pips is my vanilla flavored trade, and it is pretty much when in doubt, 20 to 30 pips and I'm out. But there's a more mathematical strategy that I want to introduce you to here tonight. It's about figuring out what is the easy pips for the pairs that you're trading on the time frame that you trade in the current market environment. What's the easy pips? And I'll go a little farther with this idea. So I call it a measured profit target, and what we're doing is we're adding a little bit of math to the equation or to the task that we have of trying to figure out how much profit we should take. What's the easy pips? Because in the last screen, I was just saying what comes easy for pound Aussie might be much different than what comes easy for dollar yen or something else. So, so the measured profit target is going to help us out with that, and I'll tell you how it works. The measured profit target is the amount in distance, in pips, of an average price bar from high to low of an average price bar during the current market condition on the current time frame. Okay, so I'm taking a distance in pips. I'm just measuring from the high of that bar to the low of that bar, not the open and the close, but the high to the low, an average price bar. Not the biggest one on your chart, not the littlest one on your chart, but just an average for the current market condition. All right, and there are some factors that could affect that from day to day. So it's going to actually change throughout the day and from day to day, etc. Certainly from pair to pair and from time frame to time frame. So volatility, some markets are just choppy and others move in a more calm pattern. Currency pairs, some of them move a lot, some of them don't. And of course, the time frame, the higher the time frame, the more distance a single bar can cover. So it's going to affect the whole trade setup, and it's going to affect how much you think that setup can produce in terms of profit. So I'll give you some examples here. An average price bar from high to low is about 30 pips on this chart. And some are bigger and some are smaller. So I just took this second bar in. It's kind of an average for what I see on this bar, just sort of visually, right? I take the high all the way down to the low, and I measure how many pips are in that candle, high to low. And that in this instance, on this euro dollar chart, it was 30 pips. And so that's kind of my measured profit target amount. That is the amount that this market can easily cover in a single bar. It's just an average distance for the current market environment. If we ended up having a lot of volatility, or we were trading during NFP or some economic release or some world announcement that you're expecting to shake up the markets, this could change really greatly. Or if you're trading during that slow period in between two active trading sessions, you might have a much different situation, and certainly if you change to a different time frame. But if you were trading from this chart in this current market condition, your measured profit target would be about 30 pips, because you can tell that that's the amount of distance that this particular market environment can easily produce in one bar. All right, here's another example. This is pound yen, and an average price bar on this 4-hour chart is about 95 pips. It's much bigger. So you can look, again, just sort of visually look at your chart, and this is just how you calculate and how you figure out what the measured profit target should be. I don't want the smallest candle. I don't want the biggest one. I want something that's an average of basically what's going on here, and I'm going to measure that from the lowest low of that candle to the highest high of that candle and see how many pips are in that space. And that's my measured profit target number. The reason why that's my measured profit target number is because that's a distance this market can easily cover in one price bar. So if I got into that trade, for example, on a hopper, and I wanted to know how much profit I should hold for, I'm going to look at the current market and say, well, that's the distance this market can cover easily. That's the low-hanging fruit there. That's the easy distance for me to accomplish with this trade. And taking what comes easy is one way to sort of, reduce your risk and your exposure when you're trading in a live market. On this 5-minute chart, an average bar is only 17 pips, whereas the same currency pair on a 4-hour chart is going to be 64 pips, right? And again, to figure out what that number is, I'm looking for an average price bar, and you can do this manually and you can do this visually. You can kind of eyeball it. And of course, I have a button that will just calculate it for you in a second, which is really nice. But I want to explain it to you because if you don't want the button, that's fine. I still want you to know how to use the technique. So I'm taking an average price bar from the high, measuring to the very low, seeing how many pips are in there. That's my number. And in this instance, if I was trading on this, maybe I was trading a combo hopper, which is when we have a hopper going down and we have prices starting to make a move away from both lines. 17 pips is what I can shoot for. That's the amount that can come easily on this pair at this particular point in time on this time frame chart with the current volatility. So it's just adding a little bit of math to that task that you have of how much profit should I try for here. And now you have something a little less subjective, a little math to throw into your picture and give you a little bit of confidence about what you're doing. And I'm going to go back one page. And when you take profit at 17 pips, because that was your measured profit target, and it ends up going 37 pips, you don't have to second guess yourself anymore and look back and say, oh, I should have let my winner run. Remember, that's just a stupid saying, and we're not falling for that anymore, because you had an actual calculation behind your decision to close your trade at 17 pips. There was some mathematical logic, and that logic is, what's the distance this market can easily obtain for this trade, and that's where I'm going to take my profit so that I can really feel like I'm making a safe, sound decision. So the measured profit target, it's just adding a little math to your equation for figuring out where to take profit. The measured profit target, it's just a number. It's the average distance that's easy for the market to cover based on current conditions. When you apply that number to your trade setup, you get a profit target that has some logic behind it. That's going to make you feel great when you close that trade, no matter what happens next. You get a profit target that should be an easy distance for that particular market to cover in that particular point in time, on the time frame that you're trading from. You get a profit target number that can be accomplished with the momentum that we see, even if the potential and duration of that trade fades out quick. And I don't know if you've ever gotten into a trade and the market starts off really strong and then it just makes you wait forever. Even if that happens and that momentum sort of fades out, it's a distance that we normally can see the market accomplish just with that first push of momentum. So even if the potential and duration for that particular hopper or that particular trade setup fails or fades out quickly, we still have a pretty logical point that we're aiming for, that we should be able to get with a fair amount of ease. So now we're going to do the same thing to figure out our measured stop loss. Okay, same exact thing. The measured stop loss is a number. It's the amount of distance in pips of an average price bar that it goes from high to low during the current market condition. Same exact measurement. The measured stop loss is a number that tells you how far the market can move in one direction without meaning anything. Okay, so this is a different twist on we're taking the same exact technique for getting that number, and when we're looking for a profit target, we know that that's an amount that the market can easily accomplish in a single bar. But the flip side of that coin is that's the amount the market can easily move against you and not mean anything, just mean it's messing around. That's just how far this market, weaves up and down as it's making its way in one direction or the other. Your trade needs wiggle room, right? But how much? That's always the hard part. A stop loss that's too big means that you lost more than necessary when the market does turn on you. And in my mind, a bigger problem is a stop loss that's too small. It means that you're going to give up a loss maybe when the market was still in the correct position for your trade. And that is just as bad. Even though it's a smaller loss, they can add up over time. And so we're going to add a little math to this problem and see if we can find a solution that will help you out in those moments that you don't know quite where to put your stop loss. So you can apply the measured stop loss number in a lot of different ways. And here are a few ideas for you. You can take that number and apply it to the boundary of your trade setup. So for example, if the boundary of your trade setup is the recent high, because you're trading maybe a counter trend retracement off a high or something, you know, right before the market, you know, gives it up and falls into that retracement pattern, it might really struggle to get past that high. And how many times have you seen it just spike over that high and just go far enough to hit your stop loss, and then it drops right into the pattern that you were planning to trade? It's a really common problem because you don't want to have your stop loss too far away, but you want to have it far enough away. So what I'm suggesting is you take that measured number and you apply that to the boundary of your trade. So you put that above the high, and that gives you at least some logic, you know, some mathematically, you know, logical distance of wiggle room that your trade might need if it does get a little bit spiky up there. You can apply that number to the high of the bar that opened your trade. Sometimes that creates an even bigger stop loss than putting it to the boundary of your setup. Or if the market has already started moving into the pattern, you know, that might tighten it up for you a little bit. So you don't have to put it all the way up to the high. You know, you can tighten it down a little bit with a little bit of logic. Once again, if you're selling, for example, you put that stop loss above the high of the bar that opened your trade, and you at least are giving it as much wiggle room as you would normally see that market move in a single bar. So if it does move that far against you, you're out as quick as possible. You could apply that number to the high of the current price bar. And this gives you sort of the minimal amount of wiggle room as the market is moving in a direction, and the market will kind of indicate what it needs over time. So you can keep using it almost like a trailing stop for people that like to do that. I generally don't move my stops around like that, but you certainly could run that calculation ongoing. If your trade ends up being open for a few days, you know, you might want to change the stop loss throughout, you know, that period of time. You could apply that stop loss to that number to the edge of the closest combo line. And this is like when all else fails. Is it maybe not for the retracement where price is coming back to the combo lines, but a lot of times we're trading in between the combo lines with a combo hopper where we're trading away from the combo lines, those moving averages. If this is new to you, please refer to the previous lessons because we've gone over a lot of that. But if you apply that number to the edge of the closest moving average, it gives you the benefit of price action plus the wiggle room, you know, according to current market conditions. So you get to kind of measure it. And so I'm going to show you some examples of what that looks like. The average price bar is about 40 pips in this example. And of course, I have a button that will make this easier for you. When you want to know, you just click the button, and it's like saying, hey, what is the number? What's the measured stop loss distance? And then you can decide how you want to use it or if you want to use it. So in this example, it actually does the math and says it's exactly 38.8 pips. And you can tell the button, I want you to go ahead and apply that stop loss for me, and it will apply it to the high of the bar that opened your trade if you're selling in this example. Or you can just say, no, I don't want you to do anything. I just wanted to know what the number was so I can make a decision about where I want to put it. Maybe you want to apply 38.8 pips to the high of this particular sell setup, and that would be how you'd want to use the number. Okay, but it's just, I told you it's just an average bar, and you're going to take the average, you know, bar and the distance from high to low of that bar to get the number. And then there's a lot of different ways that you can apply that number depending on your trading strategy. All right, so the measured stop loss and the measured profit target, one question that's come in a lot is it the same number? And the answer is, in the same moment, yes. It's the same exact number. And because you're taking it, when you're trying to find what comes easy in terms of profit, you're looking for an average distance that this market can easily cover. And when you're looking to protect yourself with a stop loss that you hope does not get hit, you want to use that same number to make sure that you know how far the market can move around without meaning anything. So you at least want to put that much space between you and, you know, maybe the boundary of your trade, or, you know, something else that's close by. But it gives you something to work with, so you can figure out, you know, whether you're planning for where to take profit and what comes easy, or what's an easy distance for this market just to get jumpy, so that I make sure that I get my stop loss farther away than that. Does that make sense? All right, so the next question that I get a lot is, am I saying that you can just randomly open a trade and apply the measured stop loss and the measured profit target and you'll be okay? And my answer is no, silly. Don't forget everything we already talked about. What the hopper and the momentum bars and the point on your chart where you can expect momentum, you know, the strategies, right? So plan your trades with the benefit of expectations about momentum and direction from the MACD and the combo lines. And as we've already learned in the last 4 lessons, it's pretty cool. Then apply a stop loss and a profit target with some mathematical logic about what the current market can do in terms of how far it can move in a single bar, so that you can make the best possible decision about how far away to put your stop loss, and also how to take profit quick with an amount that should come fairly easily, especially if you're lining up your point of entry with a hopper or something like that that gives you some probability that the market's doing something. It's ready to go, and you're going to go with it and grab those easy pips. Sometimes it's 30 pips, sometimes, you know, it's going to be 95 pips. But the measured profit target button is going to tell you what that number is. All right, so the button is on sale right now. If you happen to be visiting this video recording after the sale is over, you can contact me, combotraders@gmail.com, but it's on sale right now if you're here live or you're here in the fall of 2016. And you can visit my, my website at simplycombo.com/button-fall-sale to check it out. All right, so when you want to know the number, here's how it works. You just click on the button and it does the math for you. It's like saying, hey button, what's the number? And the button says, hey, your number is 34.6. Do what you want with it, you know? And the button will ask you if you want to set your profit target to that number, and you can say yes or no. It'll ask you if you want it to set a stop loss for you. You can say yes or no. And there's a lot of other buttons that can change those things for you too. But the point is, even before you take the trade, it's so handy to be able to click on that button and say, hey, what is that measured stop? What is that measured profit target number? Because, you know, it might be, it's only 12 pips and you think it's really not worth it, right? I mean, that's not enough potential in this particular market environment. I think I'll pass on the trade unless you're a scalper, and then that's awesome. I think I can pull 5 pips out of that, you know? So so it's really useful just for not, you know, just one more thing to say, hey, am I making a good choice here? And if it comes back and says, hey, your measured profit target number is 95 pips, it doesn't mean you have to hold for 95 pips, but that's a nice amount of distance that this market should be able to cover easily, and it gives you something to work with. And remember, if you close your trade early, all you got to do is send me an email if you want confirmation that that was the right thing to do, because the only way to make money in this industry is to close the bag when you have some money in the bag, and no more feeling bad about closing your profits early. You know, no more listening to those people that tell you to let your winners run as if we know which ones are going to be the winners. Okay, so that's over. We're going to forget about that and do something that actually works. Use the measured profit target to help you kind of figure out what that number is, and then you decide how you want to use it. If you want to automatically apply that number to the current price for a profit target, or even to the high of the bar that opens the trade, for example, then the button can automatically place those orders in your broker account for you. It's pretty awesome. So it's automation when you ask for it with the click of a button. It is on sale right now. And I've only told you about half the buttons. There are 11 buttons, and there are 11, I believe, training videos already posted to get you going with the button. In fact, if you are interested in the button program, which is currently available, there are little information icons that you can show up next to each button. So you can click on the information icon and get a little reminder what that button does. When you no longer need the icons there, you can hide them so they don't add additional clutter to your charts. So simplycombo.com/button-fall-sell. And you can always shoot me over an email if you have any questions. So let's do a review of the lesson for tonight's lesson. Tonight's lesson was about measured profit target and measured stop loss. It's a technique for figuring out, with a little math, where you might want to put your profit target and where you might want to put your stop loss. The measured profit target and measured stop loss, it's just a number. It's the average distance that's easy for the market to cover based on current market conditions, which could include current volatility or the time frame of your chart that you're trading from. When you apply that number to your trade setup, you get stops and limits that have some logic behind them. You want your profit target to come easy. Look for the distance that the current market can easily accomplish and take your profit there. You want a stop loss that allows the market some wiggle room without giving it more than it actually needs. The measured stop loss number puts a little math into that decision as well, because that number can change and does change throughout the day, throughout the week, throughout the year, and from time frame to time frame, and from currency pair to currency pair. It's not just a one-to-one risk-reward ratio. And the reason why is because the measured stop loss is applied to, that is a number that you can apply in a lot of different ways. It can either be applied to the high of the bar that opens your trade, or it could be applied to the boundary of your trade setup. It could be applied to the closest moving average. There's a lot of different ways you can apply that number. It's a distance the current market can easily cover, so you have some idea how much wiggle room you should give your trade to give it the best chance of not getting stopped out too soon. And the profit target is applied to the open of the trade. It's just a profit target. So if momentum fades out of the market quickly, you should still be able to get that measured profit target with ease, because it's based on a distance that the current market environment supports. So with this strategy, not only is it not a one-to-one risk ratio, but I generally risk a little more than I stand to gain. And the reason for that is because I'm not expecting my stop losses to get hit. I'm not planning a stop loss that's low enough that I can, it's a 50-50 whether I win or lose. I plan a stop loss that gives the market as much room as it needs for the pattern to play out. And I take a profit target that comes easy so I can get some money in the bag and close the bag. All right, so you can add a measured profit target and a measured stop loss to your hopper strategies, and you know where to trade, where to stop out, when to expect momentum, and how much profit should come easy. It's like the whole deal. It's the whole trading deal all together in one place. The number one way to make money in this industry, don't forget, when you get some money in the bag, close the bag. That's the number one way to make money. Making a profitable trading experience takes so much less than most people think. MACD strategies alone can easily produce 2 trades per week for 30 pips each. And it would be great to see what 30 pips a week every week looks like in your trading account. Measured stop loss and measured profit targets can help you figure out what you should be aiming for. And when in doubt, just stick with the math. I like to say, just the math, ma'am. All right, so that's it for tonight. But coming up next time, we're going to talk about the Monday trade hopper. It's usually good for 100 pips, so you're not going to want to miss that. I'm also going to tell you about the MACD close. It's another MACD trading technique. Sometimes it's a stop loss, sometimes a profit target, sometimes it holds you in a trend, sometimes it gives you an early exit. It's an amazingly useful MACD trading technique, and I can't wait to tell you all about it on Thursday. Same time, same place. I have to thank you very much for joining me in tonight's webinar. Again, the button is on sale. simplycombo.com/button-fall-sale. You can always find me at my email, combotraders@gmail.com, and I'll talk to you soon. All right, I'm gonna jump out of the presentation and figure out how to get back to you. There you are. Okay, and then I'm going to check out the chat and see if there are any questions or comments or anyone wanting to ask me anything at all. All right, I don't see any questions or comments, so so we're good for tonight. Thank you for joining me, and thank you for visiting the recordings page. If you do have any questions later or after you catch the recording, please don't hesitate to send me an email. I love to hear your questions, and I'll answer them in the next session. So it's combotraders@gmail.com, and I'll see you on Thursday. Have a great rest of your day.